Hello and welcome to another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general advice or general information rather only, and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research for analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining and energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And of course, for more information on the above, please see our people section at www.nucleuswealth.com. So welcome now to our next instalment for, of course, and our first one for 2018, entitled Will 2018 Trump 2017? It's obviously been a remarkable year for markets. It's been a remarkable year for the US political sphere and spectrum. And today what we're going to do is break down, I guess, our thoughts and our forecasts for from a market and an investment perspective. So if you're looking for the latest on tweets and the authenticity of Renoir paintings, this probably isn't a great podcast for you or webinar for you. However, we will be looking at it from a perspective that we take in our day-to-day business running investment money and as an investment company. So on the agenda today, we're looking at obviously politics and how that parlays into investment, engineering a boom. We're looking at the topic of synchronized global growth, and then of course how that runs into China rebalancing. And then finally, the idea of a market blow-off and tips and traps and our thoughts on how we can work that into our investment mix. So welcome to you, Damien and David.
Thanks, Tim.
Thanks, Tim.
No problems. And what we'll do is we'll kick off the topic of the day with politics versus investment. So we've got here that it doesn't mix. What are your thoughts there, Damien?
Yeah, look, I think the key thing to come back is that people overestimate how much particular things are going to influence markets. So whether it be that you're a hugely negative on the unfunded George Bush tax cuts, which then saw the market, rally significantly following that, or if you thought that Obama was the worst thing ever for markets, and that bringing on an untried liberal sort of left-wing senator to run the country would be terrible for the whole for the US economy, and only to see markets significantly rise in the US. So the key thing is that you really need to look at them completely separately and acknowledge that first of all, they don't have that much control. A lot of the things they do will be lagged. And that also politicians are usually incredibly short-sighted and very short-termism, and sometimes that's good for markets. They throw a lot of money in, they put a lot of focus on effects that are going to be that are going to juice the markets for a year or 2 years, long enough to get through the next election cycle, with the view that the long term doesn't really matter because they're probably not going to be in power. And so, and that can be good for markets.
And so I guess essentially there's sort of an injection of volatility really based on popular belief and popular vote.
Yeah, but it all comes back to you can have your views on whether you like people or don't like people, but just don't let that influence your investment. And whether things are good for the long term may not actually might give you the opposite effect in the short term.
Okay, sure. And I guess then looking at the engineering of a boom, what can you tell us about here in regards to the tax cuts?
Yeah, sure. So our view is that Trump's engineering a boom, and that he's very short term oriented. He doesn't care about the long term because he figures he either won't be there in terms of won't get voted in for a second term, or I guess he's got a relatively short attention span, it seems, and so quite possibly just doesn't think that far ahead and just thinks, well, the first thing we've got to get is as much money into the economy and as much money sloshing around for businesses as he possibly can. So we've seen the tax cuts passed. We've sort of been a long proponent that they would get passed because it is all in the best interests of the Republicans and most of their donors. And so we've seen the tax down to 21% for US companies. We don't think that's going to make. We think it's going to make a decent sized effect, and it's going to be quite a long term. The effect isn't all just sort of front loaded into 1 year. What generally tends to happen is companies will you'll get a tax change, and that'll give you sort of 5% ish in terms of the earnings per share growth, we think, across the market. But then the effect is the next year, then they'll be restructuring their tax affairs, and there'll be a bit more coming out in the next year and the next year. What our view is that with any tax changes, that companies have their whole structures based around paying lower taxes. So, for example, US taxes were somewhere north of 35%, depending upon which states and things like that you're in. The effective tax rate companies were paying in the US was more like 27%. So it was already significantly below that. You'll get a leg down, and then you'll get companies restructuring how their whole affairs and how they, where they put things to get that tax rate even lower again. And so that effect will keep coming over time. So, but again, it's a live for the present. These tax cuts aren't funded. It's probably talking about $100 billion, at least in terms of the annual effect. And so it's sort of too big for investors to ignore. Whether you think it's a good thing or a bad thing that companies end up with more money, and whether the money will actually be spent. The reality is it's a big amount. Companies will be more profitable than what they used to be, and some of that money will inevitably end up back either in the market itself or in terms of increased demand.
Okay, sure thing. And then looking at obviously one of the big platforms was the returning of foreign capital, although my understanding is a lot of it sits inside of America anyway. It's just denoted as foreign capital. But
that's right. And so the big thing here is it was if you were a company like an Apple, which has got sort of the most amount of money overseas, what you'd find is you'd earn money from some of your foreign subsidiaries. You'd do some fancy tax structuring to get your tax rate right down. Then you've got the cash. If you then brought that cash back into the US and paid it out as a dividend to your shareholders, that would trigger an extra tax you're going to pay in the US. So basically, you earned that cash, and then you stuck it in a bank account overseas and just let it grow. And so, periodically, US politicians come out with some way of trying to get people to bring that money back, and it's sort of a mixture of a carrot and a stick. There's a decent bit of carrot in it at the moment, so quite possibly we'll see decent chunks of this capital coming back. And some of the latest figures, it's probably getting close to $2 trillion in terms of money. How much of that actually comes back is sort of hard to tell. Apple, there's actually sort of Apple and 4 or 5 other stocks have got the bulk of it. I think about 60-odd% sort of sit within just a few companies.
Wow.
We expect that money isn't going to be like this whole thing about, we give these guys a tax cut, they'll bring it back, they'll invest in R&D and employ more Americans and all this stuff like that. We don't suspect that will be the case. We think it'll be more we put into buybacks. A lot of these companies sort of ironically have a bit of US debt, so it'll be used to pay down debt, because what they do is, rather than bringing the money back, they leave it overseas. It's cheaper to borrow in the US, leave the money overseas because you don't trigger this tax thing. So the money that comes back will be used to pay down debt, be put into buybacks, and so it's quite possibly going to be sort of pushing the markets even higher, stock markets higher as that sort of washes through the system.
Okay, sure. And then I guess moving on to the directions that the present president, rather, or present government headed.
Some of the things that might happen. So infrastructure spending. So usually infrastructure spending isn't a short-term thing. It's actually usually a sort of more of a long-term view, is that, yes, I spend money now, and that is good for the economy. That usually that money does bounce around a fair bit because it goes to builders and workers and sort of lower socioeconomic groups who do tend to spend it. So it is usually quite good for the economy. There's a number of things I've spoken about doing in terms of infrastructure spending. None of it's really sort of at a concrete enough stage that you'd sort of be betting on it. But it is worth noting that if you're not going to spend it on productive infrastructure, let's say you want to build yourself a nice big wall that doesn't actually provide any benefit to you, so going forward, that is very short term. So
okay.
that sort of gives you a short term boost to your economy, no long term from. Whereas if you're building an extra railway or something like that, there's a short term boost from building the railway, and then there's a long term boost from efficiencies that companies gain from having that railway.
Okay, sure.
So I would put the infrastructure spending, the more certain stuff seems to be in the short term category rather than the long term category, but both of them have sort of got a bit of a short term.
So in a sense, sort of a broader, sort of smaller size infrastructure project, sort of spread across the country or something that's actually going to get up, I guess, is probably the question.
Yeah,
you might have a win actually in pushing something through.
That's right. But I guess where I'm trying to get to with all this is it's all this thing about how are we going to create this big boom for the next few years, with the idea that when that money fades off and you've done your infrastructure spend and you found out that these tax cuts don't pay for themselves and you've got this higher debt and all these things like that, that's tomorrow's problem in terms of the current government. They just want to engineer this boom. Yep. And that's where we're sort of taking it is, well, there's a bust coming. A lot of this stuff is unsustainable, but you don't sell before the boom even happens.
Okay, sure. Currency wars.
Yeah. So China in particular, he's spoken a lot about China having a currency that is not valued correctly, and so if you can get the US dollar down versus China, you then sort of bring in you bring in less imports and you get a bit more exporting going yourself. He's spoken about protectionism. A lot of these things are sort of, you can get some short-term wins from it, and you get a few more people employed, in local areas and stuff like that. But generally, the long-term effect is negative. So I guess it's all that part. If it all gets up, if he builds a wall, he gets currency wars going and continues in terms of trying to get protectionism and rewrites the NAFTA agreement and things like that. There's probably a bunch of short-term wins, with a long-term effect being negative for the American economy. But yeah.
That's sugar hit stuff.
Yeah, and it's a couple of years down the line.
Okay, sure.
So the thing is, this stuff's coming, but it's you do need to wait until markets actually get to that point.
Okay, yep. And then finally, on the engineering and booms topic, he's just rolling into letting the next guy pick up the pieces.
Yeah, exactly. So I'll flip across to David, but that's generally my view, is that he's trying to engineer a boom with the view that it's somebody else's problem, the bust, if he's still around, if he hasn't been impeached, if he's still been elected and all that type of stuff. But I honestly just don't think he's looking that far in front. It's all about engineering this boom at the moment.
It's all about the short-term deal. Okay, very good. Any notes on that one there, David, or shall we move into the synchronized global growth?
Well, the key thing to add to that, which is to some extent derived from Trump's actions and some of its good fortune, is that the US dollar has started to fall precipitously as well. So his engineered boom is going to get a massive Forex tailwind as well.
Okay.
And that's coming out of what we're next going to talk about, basically, which is this global synchronized growth that, is the sort of buzzword in markets today. It roughly comprises simultaneous good growth across the developed economies, US, Eurozone, Japan, and then throw in China and emerging markets as well, are all going very well at the moment. That chart there shows you, I could have given you millions of charts on this, but this one's pretty much clear enough. The red line there is manufacturing PMIs across the US, EU, and Japan. As you can see, it's at post GFC recovery highs.
5-year highs at least, yeah.
Yep. And, there's still very good kind of signals of building domestic demand in the Eurozone and Japan, as well as Trump's boom. So what this has kind of done is taken Trump's boom global, I guess you could say, in some sense through the falling US dollar, as well as, through lifting confidence, but also just the coincidence of a recovering Europe and, a rebounding Japan on, its own policy undertakings. So, the sort of focus of markets right now is just all of the cyclical drivers that have kind of overwhelmed the structural problems that we know are in all of these economies and that we've all been worried about post GFC. And so the question now kind of becomes, well, how far does this boom go, and can the entire world kind of get swept up in the Trump boom? In which case, Australia would follow suit, because commodity prices would rise, and so would the Australian dollar, and we'd see animal spirits unleashed, as it were, all over the world. But if you just move to the next tile,
I was just going to say, so essentially the backbone of all of this is just this global rising confidence. So there's just
there's a whole bunch of different policy endeavours underpinning a return to growth in different jurisdictions. We don't have the time to go into all of them.
Sure.
But, if you look at that red line there, you can see the first kind of iteration of the big rebound, which was 2016. That largely came out of China.
Okay.
When it stimulated its butt off after the 2015 downturn. And then there's this big second leg in 2017, which came out of the Eurozone recovery, which is just the case of having low interest rates for a very long period and plus easing up on a lot of its fiscal austerity. And then the Trump boom, of course, which started to drive up global markets like crazy all of last year. So lifted confidence in that, and then the wealth effect, etc. I mean, these days you've got to remember that, although we sort of like to think of equity markets as following economies, it's actually the other way around a lot of the time. And you can create your own activity simply by driving up asset prices, as we know.
Yep.
So anyway, I'll move on to my second chart here, and the question I want to ask for 2018 and whether it can trump 2017 is can synchronized growth continue across all the major economies? And the major risk that I see to it is China. This is really the key chart, which is Chinese broad credit, and you can see there very clearly the stimulus pulses that have gone through China post GFC. So when things got really ugly in the GFC, they obviously primed like crazy and threw a lot of credit at the economy. Then Xi Jinping came to power amid great fanfare of rebalancing, but he hadn't really consolidated his power. And so in 2013-14, he immediately re-stimulated the economy while he kind of sorted out his enemies. And then they really did try their hand at restructuring through 2015, let housing markets slow a lot and did a lot of rebalancing stuff in heavy industry, and curtailed credit. But we know the story there, where growth fell very heavily with credit, as you'd expect.
Yep.
And at a certain point, it became too much for the Chinese Communist Party leadership, and in early 2016, they stimulated again. But as you can see, the roll-off on that last pulse is now steepening.
It is quite a substantial drop, isn't it? Given the
it is
the previous years.
And there are lags in this, but sort of 6 months or so is not a bad rule of thumb in terms of transition from credit to growth. And so, it's been falling now for a good almost 12 months, and we have actually seen the first signs of slowing in investment, but it looks like it's going to continue to slow. So if we just go through the next couple of slides, I'll show you, some more evidence of this slowing credit.
Sure.
The next one is bonds, and again, you can see that in 2016 they really stimulated hard in terms of infrastructure. If you come down to the next one, they also unleashed the housing market again, and there was quite a boom in mortgages, which is the orange lines. But all of those things, as you can see, have rolled over and are falling. Now, will this disrupt a global Trump boom? I don't think it will disrupt it exactly. It's not going to be a rerun of 2015 at this point. Probably the key slide here is the one that's up there, and that is mortgages. As you can see, mortgage growth, it's come off very sharply, but it's still very high, even so. And so if we move to the next chart, you'll see that China's house prices have been brought off the boil very effectively, but they're kind of stabilizing as well. Now, this is the first for China. Normally, it has a very distinct boom-bust cycle in its housing market, but it used macroprudential policy this time, which gave it a lot more flexibility. And it looks like it's going to sort of move into something like a slow melt, rather than the precipitous falls of previous cycles.
That then just terminates another big credit pump again. To
exactly
get the boat rewrite.
Yes, exactly. I think what they're basically trying to do is create a kind of Western-style housing market that goes up, like clockwork, a little bit above income growth. I mean, maybe 5% or something that's sort of manageable over a longer cycle. So what that means is that housing construction and residential construction generally, which is the largest consumer of bulk commodities, isn't likely to crash. It's just going to kind of erode as infrastructure comes off as well. So that means that all of this is probably material for bulk commodity demand, which is the one that matters most to Australia. And I expect by mid-year this will be very clear. All of this, of course, depends on China electing to let it continue. Now, there is some risk that the Chinese Communist Party gets drunk and decides to embrace the Trump boom and re-stimulates itself, in which case it will be a genuine global blow-off. At this stage, though, the signs are that isn't happening. There's credit. They're also allowing the yuan to appreciate as the US dollar falls.
That's interesting.
And so they've basically accepted that they're going to have to take some pain in terms of rebalancing vis-a-vis, the US-China imbalance that Trump hates so much. And so that's a bit of an accession to our Donald. And both of those things are typical of a rebalancing push as opposed to more stimulus. So at this point, it does look like they're going to let things ease off. And so when we coming back to sort of Trump boom and whether or not it can go global, Chinese demand probably says no. But at the same time, as I say, it will probably be fine, and it'll still have some support from external demand. But then there is this one last kind of fly in the ointment, which is that the US dollar now falling quite fast also puts a bid under commodities. And what China basically means to a large part of the world in terms of its impact on growth is commodities.
Absolutely.
Like it's enormous commodity demand. And so, there is this risk that even if Chinese demand comes off, commodity prices could still rise because the US dollar is falling. So it's a sort of, when you're asking if the Trump boom can continue next year and whether China can be part of it, it's kind of a battle between the US dollar and fundamental Chinese demand. There are a couple of reasons.
I was going to say, who's going to win that one?
Yeah, well, that's the key question for Australia. Like at the moment, we're sort of seeing Australia as the odd man out in this global boom. If commodities go nuts, then it will join it. But the base case is probably that it won't. There are two main reasons, one of them which I've already mentioned, which is the Chinese yuan is not falling with the US dollar. It's rising. And what that does, it means that Chinese hoarders of commodities have no motivation to buy. Often in these cycles, as the yuan falls, they all commodities as a hedge and as just a speculation. The other reason is that the boom's been going for 2 years in China, and as a result, commodity inventories are already way off the chart.
Yeah, right. Okay.
So they're already stacked to the eyeballs.
Got
with,
that one here actually. Yep,
yeah,
there we go.
with commodities.
Wow. Yeah.
And as you can see in iron ore, for instance, the pile of iron ore in China right now is completely unprecedented. Like, it's way bigger than anything we've ever seen before. It's similar with copper.
And has this been a sort of a constructed idea, or has this sort of been a sort of a matter of chance that people have just done what they normally have done, expecting that there's the next boom will come and everyone's got full pockets?
It's two things. It's constructed in the sense that China's got more ports.
Yep.
As it grew, and so there's more capacity.
Yep.
But largely it's due to the domination of due to the financialization of iron ore. Basically, over the last few years, as futures markets overtook the spot market, it meant that a whole lot of speculators joined the market that weren't there before, and they can, most of those markets are physical delivery, so they actually have to take delivery of the iron ore that they speculate on.
Okay.
And so there's all this stuff sitting at the ports that, that sort of Joe Bloggs has bought on a punt that it'll keep going up, and so we have this enormous pile. And so if you're going to start thinking about buying commodities, if you're Chinese and thinking about buying commodities this year, the yuan's rising. That's not helpful.
Yep.
And you're already sitting atop this enormous pile as local demand is about to weaken.
Sure. Yep.
And so you're thinking, well, I probably shouldn't buy any more. At least that's my base case. And I think if it becomes clear that China really does slow this year, then the danger then becomes a big commodity destock, which will sooner or later, timing's the issue, combined with a slowing elsewhere.
Yep.
And then commodities will fall quite quickly. So just wrapping that up, Trump boom, developed market boom, emerging markets are getting floods of capital, especially out of the US. But by mid-year, I expect China to be quite a speed hump.
Okay. Look, pretty hard to argue with you there, given those graphs, that's for sure. So
hopefully they'll ride.
We'll see how we go. Only time will tell. So we'll jump into our next section then, or our final section being, of course, the inevitable blow-offs. So obviously, being an asset manager, Damien, and obviously being in the markets for many, many years, you're very accustomed to seeing things going up at an alarming rate, and then everybody hangs out to see what are you going to do when it goes down. So your thoughts there on at the moment with current pricing?
Yeah, so let me just recap quickly just to where we are. So what we've spoken about is US booming away, short-term push. So there's problems over, but they're still over the horizon at the moment. We've spoken about Europe and Japan, sort of ticking away in terms of PMIs and things like that. We've spoken about about China being the one of the linchpins to this. So if China decides to engage, then just decides to keep going the way things are going, and then commodities are going to boom. If they decide to use the cover of world growth elsewhere to actually get through and do the restructuring, which we think probably will happen, but there could easily be mistakes. They could undercook it or overcook it or whatever. So that's our sort of our key factor is that China will use the cover to rebalance. So markets have priced a lot of this in already. So we've got one side of what's happening, the second side is what have markets priced in. So I've got a chart up of the Schiller PE ratio. It's basically sitting, which is sort of a longer term look at returns. It basically takes 10 years of average returns and adjusts for inflation and then compares it with price.
Okay.
And that's at not quite all time highs, but if you look back over 130 odd years, you basically had the 2000s got us above it, and that was it. So we're up there in terms of that PE ratio. Having said that, that'll probably come back a little bit naturally. We're about to lose the 10th year of which was a GFC. Out
of the averages.
Out of the averages.
Yep.
So that'll improve a little bit. It's not quite as bad as it might seem, but it's very expensive, and that's by design. Central banks have really pushed have been out there pushing more cash into the economy, and that's ended up in asset prices.
Sure.
We do have housing prices that are sort of similar around the world that are very high. I've got a chart there of the US Treasuries, which is similar, not quite at all-time lows, but the all-time lows were over the last year or so. So bonds are very expensive in terms of their historical, and again that's over 100 odd years of bond data. So the question now though is, okay, we've established they're expensive. Markets can be expensive for years, and they can get more expensive. So I've sort of got a chart of speculative returns that sort of on the next one, which is coming back to looking at how do markets take this, and when do they go into this final blow off stage where they're expensive, but they get even more expensive, and you get this whole fear of missing out, and this whole greed,
self-feeding cycle.
Yeah, that's right. And usually that's what you see within markets. Our view is that look, we're starting to head that point. We're starting to head towards that point. We're not at the sort of peak yet. We haven't quite got the same. The taxi drivers giving you stock tips on the way to the airport, or the
usual armchair indicators.
That's right. You're at a barbecue and everyone's telling you about how much money they made on this, that, and the other. Having said that, there are everything's always slightly different this time. It's always very similar, but there's always something slightly different. If you're talking to anyone who's 20 to 30, then you probably are talking about some sort of blow off, and it's usually in the cryptocurrencies.
Okay.
So maybe some of the heat in the market is sort of hidden at that part.
Yep.
So that seems to be I'd say in terms of the your shoe shine index or your taxi driver index, all you have to do is ask somebody who's in any way invested in the sort of cryptocurrency what their thoughts are, and you will get that same. I don't know anything about finance. I don't know anything about this, but I know a great deal when I see it, and this thing's going to the moon.
Yep. Love the story. Believe the story. Believe anything.
Yeah, that's right. And that's the same type of behavior you generally see at the top of market cycles.
Sure.
So the question is, will that translate back to the real economy? Are there feedback loops between the two? When crypto crashes, is that where it's hidden? Maybe.
Well, obviously there has been great lengths to isolate the sort of crypto mania from financial markets. And do you think there's perhaps a little bit of a government hand to play in doing that, in trying to to keep that catalyst out of a a boom?
Yeah, it doesn't seem like crypto is big enough yet to really make a huge shock to the world economy. But having said that, it's probably pretty concentrated from what we can tell in the sort of younger demographic, and they're the people who generally don't have the asset prices that have shot up.
Yep.
They're not the big owners of property and stocks, but they are big spenders in terms of they're out there and
creating demand.
So a lack of demand from that area of the economy would be bad if that's what it manifested itself. The fact that too many people have taken out $2,000 loans on their credit card and thrown it into cryptocurrency, and
now they're not buying iPhones.
Exactly. So the question is what indicators do you look at to try and work out when this turns, and is there anywhere you can hide?
Okay, sure.
So where can you hide at the moment? Given everything's expensive, basically you can hide in cash.
Wow.
I mean, there's lots of little assets, but there's no big assets out there where you say, okay, here is a big asset that looks undervalued. There's different types of ones we can say, I can pick small sectors of stocks, or I can pick, particular less liquid assets or things like that.
Yep.
But the reality is, if you're scared about the blow off and you're scared about how expensive everything is, and you're saying, look, I don't want to lose out, you've basically got to say, I'll go to cash and I'll hang out there and get zero or negative returns. Especially after you take into account inflation, on that for a few years, or either a few months or a few years, but you're safe that if everything comes crashing down.
And do you think, and probably a story for another day, but just quickly, obviously, global interest rates and even just local interest rates are having an impact on that because of they're so suppressed versus a hot equity market or and crypto for another poor example.
Yep.
But is that essentially exacerbating the whole problem because we've got you've really got two choices. You've got a fast horse or you've got a turtle.
Yeah.
Which one do you ride?
Absolutely. But it's by design. The central banks are all trying to push all this money out and get people out spending and get people out investing. And so by their design, they're trying to get everyone out of cash, everyone out of bonds, and get them all into stocks and get them spending money.
Okay.
Yeah,
sure.
But having said that, their ideal thing isn't that you're pushing them into stocks that just go up in price. They actually would like that money to go into new stocks and finding, hiring people and
innovation and jobs and growth. Okay.
Yeah. But that part's not happening. It is going into the stocks, but the innovation and growth and all that type of stuff is much slower to come.
Okay, sure. And I guess in terms of signs of the end, what have we got here?
Yeah, so these are a few indicators that we look at. Market breadth is probably the key one, and none of these are infallible, and none of them show up every single crisis. But these are the types of things you look for. So what I mean by market breadth is what you tend to see when markets go through their final blow-off stage and before it all falls apart is that it's led by a few stocks. So you get a few big, whether it be Amazons and Apples and some of these massive companies that keep going up while the average stock or the median stock more like sort of all start to fall.
Okay.
And so we haven't really seen that. It has been relatively broad. So when we start seeing signs that there's the performance is focused on one particular sector, that's where we start to get concerned.
Okay. So it's sort of essentially a bit of a rising tide and then trying to figure out which boats are going to fall the fastest when it comes back down again.
Yeah, absolutely. The performance of quality and value versus growth stocks. So usually in the blow-off sections, you get this. You get people starting to extrapolate out and say this boom's going to last forever and it's going to go on for another 10 years or 20 years or whatever it is. And the highest growth stocks are the ones that really take off.
Yep.
And the cheap stocks or the good quality stocks, the normal everyday stuff get left behind in terms of it's old school, it's no longer relevant and all that type of stuff.
So they get overtaken by the story, but not by the business model essentially, or the quality of the company.
And so what you see is that mixture of trying to find good quality stocks that are cheap. That's where we sort of tend to focus on in terms of our stocks.
Absolutely.
They don't tend to perform as well on the blow off, but they make you money because they don't fall on the downside as well.
Quality stays.
Absolutely. And when the stocks on price earnings multiples of so the price divided by the earnings is sort of like 30, 40, 50 times, and then that falls down to 15 when it all comes apart. The stock that was already at 15 and falls to 13, the price fall is a lot less.
Yep, sure. And then I guess ultimately though, where do you think we sit at the moment, on the cycle? Are we actually, is it happening sooner? Is it 2018? Is it 2019?
Yeah, look, we wish you knew. Everyone wishes they knew exactly.
Yep.
I think the key message is we're late in the cycle.
Mm-hmm.
So what we're really trying to do now is not sort of, we're trying to tread this fine line about saying, look, you could go to cash now, but you might be sitting there for 2, 3, 4 years before, and with markets rising,
missing big upside.
Yep. And so what we're really trying to do is tread this fine line about saying, look, we know we need to be protected. We know we need to keep enough assets in some of your bonds and your cash, and keeping an eye on that part of that safety part of your portfolio.
The war chest. Yep.
Because that's the part when stocks do fall, they'll go up, and that'll give you the chance to buy cheaply.
Okay.
And then keeping though enough of a toe in the water on the other side. And again, our thoughts continue to be that international gives you the best upside. There is that if you do go into a commodity-driven sort of blow-off, we'll underperform.
Yep.
You'll get your commodity stocks that fly up, and the Aussie dollar will keep going, but you're still going to be going up. It's going to be a question of saying, well, commodities added on, and commodities stocks might have added on 15%, and the rest of the world added on 12 or 13%.
Sure.
And so you're going, well, in aggregate, I'm still
okay.
I'm still doing all right.
Not leading the pack, but they're not leading the pack on the way down as well.
Absolutely. and if something happens, you get a sudden shock, or war breaks out between North Korea and South Korea, or whatever it is, that and you suddenly get something comes from left field, and you suddenly get a shock. is that if you're in these world growth stocks, the Aussie dollar is going to hedge you on the way down, and that you're going to find that, as we've seen a few times recently, is that stock markets fall by a few percent, the dollar falls by a few percent, and you sort of balances out your and protects you on that downside.
Okay, sure. So in a nutshell, I guess essentially we're sticking to our guns. We're buying quality and value, avoiding the overtly growth sort of stories that are out there that are driving these massive PEs, and then keeping that war chest.
Yeah,
on the other side.
And we can absolutely see a case where China doesn't slow, and we do end up in this world synchronized growth, and we go into this mega boom where everything's sort of off and running, and so. But we don't think that's the most likely case, and we also think that if China slows too quickly, that they're the stocks that are going to perform the best under that scenario are the ones that are going to get hit the hardest under the opposite scenario.
Makes perfect sense. Okay, very good. Oh, well, thanks, gentlemen. I'll hand back over to David for some final words, if you like, David.
I'll just add one thing. I'm prepared to take a punt on where it goes, which is I think we will see this kind of synchronized boom through to the middle of the year.
Okay, that's short.
Yeah, and at some point, we're watching, as the US dollar falls, we're watching oil go up quite sharply, which is going to deliver a bit of an inflation boost
locally. In Australia,
pretty much everywhere.
Globally, okay.
I mean, at its current pace, it's going to be similar to 2016 rebound. Don't get me wrong. We don't think inflation's about to roar back. It's structurally low. But I think the sell-off that we're seeing in global bonds could well accelerate into that. And at some point, we'll probably get ourselves a little bit of a drawdown in stocks. But then I think the most likely case then is China does slow, and some of that inflation concern will go out of the market.
Yep.
And we get our final surge on the back of that.
Yep.
As the Trump boom and developed market boom, proceeds. And so my best guess is we'd be looking at 2019 for it to come apart.
Okay.
But, as Damien says, the allocations are set up in a way to maximise all possible scenarios, basically.
Okay, fantastic. No, thanks very much for that. And we'll finish it off there for our webinar proper. We'll just quickly roll into a little bit about us. So obviously, Nucleus Wealth is an investment house. We do all of our own investment stock analytics and obviously strategy in-house. We use a separately managed account structure through a company called Linear. What that does is give our clients unparalleled transparency to the individual share portfolios that they effectively own, that we manage for them. And everything's backed by either the ANZ Bank for cash management or JP Morgan as a custodian of the stocks as well. So what we think is the gold standard for putting together a wealth product for our clients to give you the transparency, but also the security. In addition, we do offer 19 individual ethical screens, which then you can use to tailor to your ethical preferences as you see fit. But it also gives you the ability to give to essentially use some themes that you might feel you don't wish to invest in without missing out on the upside of other ones. And that's certainly something in the ethical investment landscape. It's quite difficult to get. Of course, we offer the complete investment solution. We do also do individual stock portfolios, international and Australian stock portfolios, if you'd like to just get exposure to those areas. We've managed to get our fees down to fantastic levels due to just typically, basically removing multiple layers of middlemen, which we've found in the industry that like to clip the tickets. So if you remove those, you become very cost effective, completely transparent, as we said, and obviously we have the tax effectiveness of those share portfolios as they're owned in your own name. Coming up, so next Thursday, stay tuned, same bat time, same bat channel, for our next Nucleus Insights called Rates of Interest. a global review. Really looking forward to that, and a bit of a must hear if you're wondering about where obviously interest rates from a global perspective are headed. So we look forward to your attendance, obviously, for coming along then. And just finally, Matthew, our communications expert here, is going to be sending out a quick survey just to give us a bit of guidance on directions you'd like to go in terms of content for upcoming webinars, and a bit of feedback about how we've gone today. So on that note, I'd like to thank you both, gents, for coming in and sharing your thoughts on whether 2018 will trump 2017. And we look forward to your attendance out there at our next one. Thanks very much. Cheers.